Oracle cancelled the expansion of their most important AI data center in March 2026. Then 5 weeks later, the stock jumped 13% in one day. That does not add up. And when something does not add up in a story this size, there is usually a reason. I went through every filing, every earnings call, every analyst note on this move. The rally is real, but the number it is built on has never been published. The IGV software ETF, which tracks the biggest software names in the world, went up 4.9% in the same session. Its best single day in over a year. That is what sent me down to this. And the further I went, the more the picture changed. Quick note if you are new here. Oracle makes the software that runs the hidden infrastructure of the business world. Banks, hospitals, retailers, it is almost certainly in your portfolio through any broad market fund. Now, here is what happened in the 7 days that drove that 13%. In the 7 days leading into April 13, 2026, Oracle fired 3 signals at the market in quick succession. On April 6, 2026, Oracle named Hilary Maxson as its new Chief Financial Officer, effective immediately. She had spent years at Schneider Electric steering a $45 billion industrial manufacturer through the exact kind of transformation Oracle is now attempting, turning physical infrastructure into a software and energy platform, managing capital cycles that span decades, not quarters. The market read that higher and understood something. Oracle's problem right now is not software. It is power, capital, and building physical data center infrastructure at a scale it has never attempted before. The second signal came on April 9, 2026. Oracle unveiled 8 new AI agent products built directly into its existing enterprise HR software suite, not chatbot wrappers. Systems designed to make and execute decisions autonomously inside existing company workflows. Oracle has $553 billion in contracted future revenue right now. Analysts who have worked through the filings estimate that roughly $300 billion of that, 54% of the entire backlog, comes from OpenAI, the same OpenAI from the last video. And Oracle has never published what it receives if that contract is cancelled. Hold that, it becomes the center of this story. The third signal landed on the morning of April 13, 2026 itself. Oracle and Bloom Energy announced they were expanding their power partnership to up to 2.8 gigawatts of fuel cell capacity for AI data centers. An initial 1.2 gigawatts is already contracted and being deployed across Oracle's US projects in 2026 and 2027. Now, here is why that power deal matters more than the headline makes it sound. You are catering a wedding for 400 people this Saturday. On Thursday morning, your main supplier calls. There is a delay. They can deliver in 14 months. You now have 48 hours to find a replacement that can show up in time. The replacement was not the original plan, but the guests arrive Saturday whether the original plan works or not. That is what Bloom Energy is for Oracle's data centers right now. Traditional power grid connections take 1 to 2 years to complete in key US markets. Bloom's fuel cells bypass the queue entirely. Last year, Bloom delivered a full working fuel cell system to an Oracle site in 55 days. The original timeline was 90 days. They came in a full month ahead of schedule. Oracle has signed contracts expecting data center capacity to be ready now. Bloom is how Oracle keeps that promise when the grid cannot. 2.8 gigawatts. That is roughly the power consumption of a mid-sized city. Oracle needs all of it, specifically because the grid cannot move fast enough. All 3 signals landed in 7 days. The market had been waiting for a reason to re-enter a stock down 60% from its peak. April 13, 2026 was the day the reasons arrived together. But the 3 catalysts are not the story worth understanding. On March 6, 2026, Bloomberg reported that Oracle and OpenAI had quietly ended plans to expand their flagship data center campus in Abilene, Texas. That was 38 days before the rally. The Abilene campus was the opening act of the Stargate project, the headline AI infrastructure initiative backed by Oracle, OpenAI, and SoftBank. 2 data center buildings went live in September 2025. 6 more were scheduled for completion in 2026. The plan after that was to grow the size to 2 gigawatts of total capacity. That expansion was cancelled. The stated reasons: financing disputes, a multi-day outage caused by a winter storm that damaged liquid cooling equipment, which strained the relationship between OpenAI and the data center operator, and what was described as OpenAI's frequently changing demand forecasting. Oracle confirmed the existing campus was unaffected. It confirmed the broader 4.5 gigawatt agreement with OpenAI across multiple US sites remained on track. But the flagship site, the one that opened Stargate, lost its expansion after a weather event and a financing disagreement. When the expansion was cancelled, the data center operator was left with planned capacity and no tenant. Meta Platforms was reported to be in discussions to absorb the unused space. 5 weeks before the rally, OpenAI walked away from the most visible project they shared with Oracle. No press release, 1 Bloomberg report, and then 13% in a single session, on entirely different news. I want to hear from you. Do you think Oracle and OpenAI complete the full 4.5 gigawatt agreement, or does the Abilene cancellation preview something larger? Tell me in the comments. The Abilene cancellation answers one question. It raises a bigger one. Oracle's remaining performance obligation ended the third quarter of fiscal 2026 at $553 billion. That number is up 325% from 1 year ago. Remaining performance obligations is a specific accounting term. It counts contracted revenue that has not yet been delivered. Under accounting rules, a contract only qualifies if it cannot be cancelled without a significant financial penalty. $553 billion in non-cancelable contracted revenue. That is the foundation of every bull case you will read about Oracle right now. But Oracle does not break that number out by customer. Analysts who have worked through the filings estimate that approximately $300 billion of the $553 billion, roughly 54% of the entire backing, comes from OpenAI. 54% of Oracle's entire contracted future, one customer. OpenAI is currently losing $14 billion per year. Their own projections show losses growing to $74 billion by 2028. In the last Oracle video, I covered how their own employees sold $10.3 billion in shares before the public IPO opened. That is 50 to 100 times the normal rate. Link in the description. Oracle's management has confirmed the contract is non-cancelable without significant penalty. That is what qualifies it for RPO accounting. The size of that penalty has never been disclosed. Oracle has never published what it receives if OpenAI cancels. That number is the single most important data point for any Oracle investor right now. And it does not exist anywhere in Oracle's public filings. Now, imagine you are a portfolio manager who owns Oracle. It is sometime in the past 6 months. You are reading the quarterly filings. You see $553 billion in RPO. You know from analyst notes that roughly $300 billion of that is OpenAI. You pulled the annual report. You look for the cancellation terms. You find nothing published. What do you do with that? On March 10, 2026, Larry Ellison spoke on Oracle's Q3 earnings call. His exact words: "Thank God we have these coding tools now allow us to build a comprehensive set of software, agent-based software to implement, to automate a complete ecosystem like healthcare or financial services. That's what we are doing at Oracle. That's what we think we are a disruptor. That's why we think the SaaS apocalypse applies to others but not to us. 21 days later, 30,000 Oracle employees opened their email at 6 a.m. and found they no longer had a job. The argument Ellison made to investors that AI coding tools allow smaller engineering teams to do what larger ones used to do became operational policy 21 days after he made it publicly. The Q3 numbers were genuine. Revenue up 22%, cloud revenue up 44%, the strongest quarterly growth Oracle had seen in 15 years. I am not questioning those numbers. But there is a difference between what a company reports and what a company discloses. Oracle's RPO is reported. Its customer concentration is not. Its cancellation terms are not. The risk profile of the number that drives the entire bull case is not. For anyone who owns Oracle directly, the question this video is answering whether the $553 billion they are building toward is as solid as the headline makes it look. If this breakdown is useful, hit like and subscribe. I go this deep every week. Oracle's all-time high was $345.72 per share, reached in September 2025. After the 13% rally on April 13, 2026, Oracle traded at approximately $155. Set those two numbers side by side. $345, $155. The best single day in 7 months still leaves the stock at less than half its peak. Oracle's free cash flow is currently negative $24.7 billion on a trailing 12-month basis. Total debt has passed $124 billion. Capital expenditure guidance for fiscal year 2026 is $50 billion, up from an average of $1.7 billion per year between 2018 and 2021. At $155, Oracle trades at approximately 30 times forward earnings. That is not the price of a company investors have fully written off, but it is not a bargain multiple for a company with negative free cash flow and a balance sheet under that kind of pressure. Guggenheim analysts, after Oracle's Q3 result in March 2026, projected what they called a free cash flow waterfall in Oracle's fiscal years 2029 and 2030. That is when uncontracted AI revenue is expected to start converting at scale, and when capital expenditure is expected to normalize. That is 3 to 4 years from now. For the forecast to come true, 3 things need to happen simultaneously. Oracle's contracted revenue converts as planned. OpenAI remains solvent and honors its full contract, and capital expenditure moderates after the current build-out. None of those 3 is guaranteed. Here is what I'm personally watching over the next 2 quarters. Oracle's fiscal year 2026 ends in May. Maxon's first full earnings call will likely come in June. That call is the most important Oracle event between now and the end of this year. If she provides more detail on RPO customer concentration or any disclosure around cancellation terms, every analyst model for Oracle gets rewritten. In September 2025, Safra Catz stepped down as the Oracle CEO after 11 years. She was replaced by 2 co-CEOs drawn from Oracle's cloud infrastructure and industry software division. At the same time, the Chief Financial Officer seat was filled on an interim basis. That interim agreement lasted 6 months, September 2025 through April 6, 2026. During those 6 months, Oracle was committing $50 billion in annual capital expenditure, carrying $124 billion in debt, and managing the fallout from the Abilene cancellation. The most consequential financial decisions in Oracle's history was made without a permanent CFO in the chair. Maxon walked into that. At Schneider Electric, she helped steer the company through a transformation that took more than a decade, from selling electrical equipment to building a software and AI platform for industrial energy management. The capital cycles involved managing multi-year infrastructure investments at global scale are directly analogous to what Oracle is now attempting. The leadership Oracle has now reflects what the actual problem is. Oracle is no longer primarily a software company. It is an infrastructure company trying to build its way into a position that pays off in 2029 and 2030. Whether that team can hold the company together through the next 3 years is a separate question. But the composition of the leadership tells you that Oracle has at least diagnosed its own problem correctly. 3 things I'm watching. Maxon's first earnings call, likely in June 2026. If Oracle begins disclosing RPO concentration by customer or any detail on cancellation terms, the picture for every Oracle shareholder changes. Oracle's fiscal year 2027 capital expenditure guidance. If that starts declining from the $50 billion level, the free cash flow recovery thesis gets its first concrete evidence. Whether the broader Oracle OpenAI 4.5 gigawatt agreement adds new sites or loses existing ones over the next 2 quarters, Abilene lost its expansion. The next site decision tells you whether that was the exception or the start of a pattern. 2 data center buildings are standing in Abilene, Texas right now. 6 more are coming. The 600 megawatt expansion that was supposed to make it one of the largest AI campuses in the world was cancelled in March 2026. 5 weeks later, the market called the same company's stock a buying opportunity. Maybe they are right. But here is the question worth carrying. Oracle is asking you to trust $553 billion in contracted future revenue. 54% of it comes from one company losing $14 billion a year. That company already walked away from expanding their most important shared project. The cancellation penalty on the main contract has never been published. When you buy Oracle at $155, what exactly are you counting on? If this helped you see the full picture, a like for this video takes 1 second. Subscribe so you are here when the next chapter lands.